You wanted to build an algorithmic trade desk or just build an algorithm for yourself to trade your account, but you have no idea where to start and how to get through it. What if you had an 8-step approach on how to do that? Well, that's exactly what we're going to talk about today on episode 4 of the Independent Quant Podcast. I'm your host, Luis, the founder of the Independent Quant. So let's jump right on in. How do we build a rule-based strategy that we could eventually code and get to trade for us in the markets? So the very first step that we need to do as traders is define what our trading objective is. It's near impossible to want to just go out and start hacking away at getting a profitable strategy. You've got to sit down and you've got to answer certain key questions, right? So it's, what markets do you want to trade? What's your trading style? What time frame you're going to use? And how much are you willing to risk? And all those questions, they're not independent. They're interdependent, and they depend on the answer of one influences the answers of the other. That's what interdependent means, right? But if you want to focus on a specific market, it's going to dictate how much capital you're going to need to trade that market. For example, if your trading objective is to make money swing trading, that can be done really with any market. Options lends itself to it. That's what I do. You can use futures, but then time frame comes into effect there, which, let's say you want to hold the position for several weeks to several months. Maybe the futures market isn't the place for you to do that because contracts turn over potentially every month. If you look at the crude oil, understanding your trading objective and what classes are available to execute that objective is the first step in developing what your strategy is. Why are you trading in the first place? Are you looking for daily income, weekly income, monthly income, hold a position for a long time so you can build wealth? That's where we need to start. Define your trading objective. After you have a trading objective established and understand what you want to trade and how you want to trade it, now you want to choose a strategy type. Now, choosing a strategy type, the 5 I'm going to talk about is trend following, mean reversion, breakout trading, momentum trading, and statistical arbitrage. Statistical arbitrage is when traders, multiple markets, they see an opportunity, a pricing difference between two exchanges, and they buy in one, sell the other, or vice versa. These opportunities exist for fractions of a second. So it usually really big firms are the ones doing statistical arbitrage because they have the funds to be able to have the technology to allow them to do that. So that is something that I just want to kind of get out of the way. That is one of the methods. We have all kinds of listeners to this podcast, so I don't want to alienate anyone, but that's probably something that if you're not in that world is beyond your reach. But the other 4 are very much squarely in your reach. So let's go top to bottom with all these. First one is trend following. This is what I am. That's how I was trained to be. I love trend following. Trend following is trying to identify a trend at its beginning, jumping on that trend, and then getting off the trend before it shifts or changes. The big kind of popular term, saying with this is the trend is your friend till the bend in the end. So with this, we're going to find ways on how to identify a trend. And now the trend can be either long, meaning going up, or short, meaning it could be a bullish or a bearish trend. The thing with trend following is you want to be able to discover what symbol is going to be in that trending stage. So, for example, symbols that usually trend really well are commodities because they are real. Soybeans is actually a thing that grows on planet Earth. So we can see what its demand and forecast will be. It does have a seasonal trade with it. So you can usually guess at these. Now guess or assess, what is in a trend and what isn't. Trend following has its pros and it has its cons. If it doesn't move and it just kind of oscillates within a certain area, it will destroy your account. So if that's one thing that you kind of look at the markets, see what market conditions are. Are you in a trending market? If that's so, then maybe choosing trend following as your strategy may be a way you want to go. If right now if there's a lot of volatility and you see prices going all over the place, trend following may not be the type that you can go with. Second one is mean reversion. Now, mean reversion works off the concept that depending on how versed you are in statistical analysis, there's measures of centrality. Measures of centralities are, things we learned in elementary school. They're the average, the mode, and the median. The average is, as we all know, the mean. Data tends to gravitate to those three statistical figures, predominantly the mean. When price moves dramatically away from the mean, it has a tendency to come back to the mean, hence mean reversion. So if you see that maybe price is a little erratic but it's chopping around the same area. So you're looking for those moments when price is just exceeding a certain standard deviation from the mean, so you can kind of ride that price back as it's going back to the mean. So that's mean reversion. For breakout trading, we're looking for support and resistance and price breaking through through those. For those unfamiliar with support and resistance, to kind of summarize it as briefly as we can, it comes from technical analysis. If we look at a price chart, we'll find areas that prices shown a challenge to break through. It finds itself bouncing off of a high or bouncing off of a low. I mean, if that bouncing off of that low, we call that support. That when price goes down to that level, it brings the buyers out and it makes the price rally back up. But then it hits some other level where now the sellers come out. The sellers are saying, I will sell at that price. Well, that price is what we call resistance. What a breakout trader tries to do is find those moments where either news or some type of event, whether you can assess it or not as far as describe it in detail, they're looking for those moments when price breaks through one of those support resistance levels, and they look to ride that price as it moves in that direction. So that's breakout trading. Very closely aligned to that is momentum trading. Momentum trading is a mix between breakout trading and trend following, at least the way I describe it. You're looking for those symbols that have shown a strong inclination to either move up or down and do so, I say, in an aggressive manner. Their beta is probably a little higher. Beta is a measure of a symbol's strength of movement as compared to the S&P 500. So a momentum trader is looking for those that are showing a propensity and strong movement in any one direction. So you choose one of those strategy types by looking at what's happening in the market right now. Are we in a trending market, mean reversion? Are breakouts potentially possible? Or is a momentum strategy the one for you? Once you select that, you're complete with step 2, and we can enter step 3. So you know why you're trading, you know what type of market you're going to be participating in. So now you need to identify what are the rules to enter that market. That's step 3, is define your entry rules. So we want to be picky and we want to be very specific as to what constitutes an entry into the market. A very simple approach, at least for sake of this podcast, is, let's say, when the 50-day moving average crosses above the 200-day moving average, that's your condition now to enter a long position. Your entry position should be clearly stated. It should be binary as to whether or not they have been met or not. But once you have that, you've got yourself your entry rules. Now for step 4. Now you're in a trade. You've got to know when you're going to get out. So define your exit rules. Now this factors in both ways. One, when to get out as far as to stop, knowing, hey, this is as much as I'm going to lose in this trade. That is my risk, maximum risk allowed for this trade. And then the obverse of that is when to get out when a certain target has been hit, be that in profitability or a price. And we want to then assess that before we're developing this should have been your strategy development of what the risk to reward was going to be. But ultimately, you want to know when you're going to get out. The worst thing you can do as a trader is to stay in a losing position because you think that price is going to eventually reverse and start going back in your direction. Likewise, you don't want to let greed take over and stay in a position much longer than you need to, and only just to give it all back. If you've hit a good profit margin, then go ahead and take your profits and live to fight another day. So now we're moving on to step 5. So far we know why we're trading. We know what strategy we're doing. We've identified when we're getting into a trade, and we've identified when we're getting out of a trade. The next part is implementing those risk management rules. And that is, now you want to know how much of your account you're going to risk per trade. This is going to factor into position sizing. You're going to want to identify what your maximum daily loss limit is going to be. Not so much how much you're willing to lose in a trade, but how much you're willing to lose in a day. There are days where your strategy is just not going to work. There are weeks when your strategies are just not going to work. You need to know the market has shifted. This is not matching what my trade objective is. My entry rules are correct. My exit rules are correct. However, it's not playing out the way that I have planned this and have tested that it should play out. Something's going on in the market. Let me not lose any more than what I've lost already. Stop, collect yourself, and kind of approach it again. You can only do that if you knew that before, if you set those rules before the fact as to what your max daily loss is going to be. You're going to want to need to know also what your risk to reward ratio is. I kind of hinted at that when I was talking about targets in step 4, but you want to know with your strategy, what is an acceptable risk to reward ratio? Your strategy is really going to dictate what is the norm for the strategy you're having. For example, in a trend following strategy, it's feasible to have a 3-to-1 risk to reward, not so much in a mean reversion strategy. You're probably going to be looking at 1-to-1. So you want to make sure that you understand what your strategy is capable of, and then choosing a risk reward that's compatible with that strategy. Next is diversification. So this is really within the risk management, because we need to, as we take our trading positions, make sure that the symbols that we're trading aren't tightly correlated. So let's say you have chosen to risk no more than 1% of your account in any one trade. If you now take one position in the NASDAQ, one position in the S&P 500, one position in the Dow Jones, you've taken 3 positions in the same exact market, right? Those are going to move pretty much in step with one another. The speed and magnitude of which they may move may be different, but they're pretty much lockstep. So if you get stopped out at one, you're probably going to get stopped out on the other 2. And even if you don't, and you only get stopped out in 2 out of the 3, you're still down 2%. And that 1% for the one that didn't get stopped out, that one's still out there. You've lost quite a bit. So we want to make sure to diversify our trades so that all our positions aren't lockstep with one another, and we're able to better manage our trades. So after that, now you've chosen all those things. Will they work, right? That's something that we have not assessed yet. You've assessed what your entry conditions are going to be, what your exit conditions are going to be, how much risk you're going to do, but do those figures actually work? In order to determine that, you got to backtest your strategy, and that's step 6, is backtesting your strategy. And to do that, you take your strategy and find historical data, be that through your broker. Historical data you want to use is something that's comparable to the market that you're going to be trading it in, which is most likely the present market. And what probably matches mostly the present market is the recent market. So you'll take recent market data. What's recent market data is really depends on what your trading objective is. If you're using a swing strategy, then you're probably going to have to take historical data that is as long as what you anticipate your trade to be in. So you don't want to look at daily information for the last 2 weeks if you're doing swing trades that take weeks to months. You want to choose historical price data that most reflects the conditions of your strategy. While you're backtesting that, now you've got your historical data, you put your logic in, your entry, your exit rules, and you run it using the backtesting platform that your broker provides, or the one that you're using your programming language. And you want to come up with certain figures. You want to know what your win rate percentage is. You want to know what your average loss and average win per trade is. What's the maximum drawdown, and what's the Sharpe ratio? Sharpe ratio is a little advanced, so I'm not going to get too much into this podcast. But let's talk about those first 3. So win percentage is something that is very easy to understand. A lot of newer traders, that is the holy grail and the number that means the most to them. Anything, and it's also one of the reasons why traders have trouble getting better. Win percentage is important. What's most important is understanding how it relates to the strategy you've chosen. As an example, as a trend follower, if you're winning 40% of the time, that's very good. Anything below 30%, it's time to start questioning what's going on in the strategy that you just developed. But the big takeaway there is that you have to understand that if you're using a trend following strategy, you're going to probably be wrong 60% of the time, and that's okay, because you want to see that, okay, win percentage is within the scope of that strategy. Okay, now checking the box. Now we need to look at those other figures to make sure that they're in line with what your trading strategy was. So it's not just looking at the profitability of the strategy, it's looking at just the mechanics of that strategy. And that's what we are delving into right now. Got the win percentage down. Okay, is that within scope for this type of strategy? Good. Let's keep going. What's your average profit and loss per trade? Right? Now for that one, you want to make sure that it is within the scope of whatever account size you plan on trading with. You want to make sure that it's hitting, if you're risking 1% per trade, your stops or your losses aren't more than 1% per trade. If your average loss per trade is in excess of that 1%, something's wrong with the strategy. Now, as much as we would like to say that, the average win per trade, we wouldn't care how much that is, we do, right? If it's excessive, then there could be something wrong with the strategy, right? You want to make sure that you assess that, because there might be something wrong with the logic that is not catching when to get out of trades appropriately, right? And maybe in that back test you did, it's giving you some awesome numbers and you're like, yeah, I want these. But the problem is that logic may work at your detriment when you take it live. So you want to make sure that it's exiting also at the proper places. The easy one for this is that your average loss percentage is well below the risk to reward that you identified for this strategy. And that's going to be obvious to you. You're going to want to take action on those. But I really want to highlight that if your average win is higher than what it should be, given the numbers that you kind of established in the previous steps here, that is cause for concern, and you need to dig deeper into that. The last one I want to talk on here is the maximum drawdown. Now, the maximum drawdown, that's an important number because it informs you as to what size account do you even need to trade this strategy. If the maximum drawdown is $20,000, and that happened, whatever period of time it happened in, you know that you need no less than $20,000 to execute that trade. Realistically, you need a multiple of $20,000 to execute that trade. And for that, now, it also informs you that, hey, this could lose $20,000. What you have to keep in mind is what happens if, when I put this strategy on, I see the max drawdown from day one. What if I lose that $20,000 at the beginning of the strategy implementation? Because we don't know when the max drawdown is going to happen. It can happen all at once. We can have a couple winners, then a lot of losers, then it kind of comes back. But the maximum drawdown is going to inform really how much you are standing to lose of your account. Use it in that way of kind of just determining what account size does that mean I need to have. Now, after you have all those, the last step in step 6 here is to optimize and refine your strategy. So you've got all those data points that I just gave you, the win rate, the average profit loss percentage, the maximum drawdown. If you're educated enough on what information the Sharpie ratio is giving you, then you can use that to fine-tune the strategy even more. But we want to be careful in this step that we do not over-optimize, because over-optimizing creates the potential for overfitting. And that is, you can create a model that is so amazing at identifying what is going to happen in the markets that it's actually useless in the present market, because it's doing that in the market that you just tested it on. So that is the last big piece for optimizing and refining your strategies. You want to make sure that you are cognizant of how much you're editing your strategy. So now you've got you've made it, right? You've got a strategy that is hitting all your numbers beautifully. You're ready to go. Hold your horses. We got 2 more steps to go, right? Step 7 is paper trade before going live. Many platforms, the way they backtest is different than how they actually execute strategies when they're in live mode or using live market data. For example, NinjaTrader, if it by default uses historical information such as the open, high, low, and close to make calculations for any type of math that it needs to do to build an indicator. However, when it's running using live data, it's calculating at the tick level. So there could be a big disparity between your back test and your live. Now you can't account for that. If you know that, you can set up your back test so that it matches your live trading. However, all that said is there could be gremlins in the logic of what you've done. So what you want to do is step 7 is paper trade before going live. That means setting up a SIM account. We'll use an account size as large as the one that you intend to trade, and just let your algorithm go on that account and test it over a period of time. And see how it performs. This is going to be dependent, again, going back to what your objective was for even trading, and as far as how long you're going to need that strategy running live in sim before you're confident to actually put real money on it. There's no rule of thumb here or anything that I can tell you how to know. For me, a lot of the algorithms that I've developed so far have been intraday or just something that opens and closes within a week. I don't have any algorithm that holds any position over the weekend. So for me, when I paper trade an algorithm, I really only want to see it or need to see it perform for a few days. Some of them, because they are strategies that are a little more complicated, I have them go longer. But that said, there is a shelf life to any strategy, especially an algorithmic one. So you want to balance getting enough time to have the algorithm give you data as far as its performance to then doing it for so long that now you have to optimize the algorithm because the market has shifted. Just take that into account. Again, no real hard and fast rule as when you've crossed the line and it can have a successful algorithm that you can take live. It's all going to depend on your confidence of that algorithm performing in the market. Now we've made it to step 8, final step, continuously monitor and optimize. Now that means that you have made it through step 7, you've sim traded that strategy, you're confident as to how it's going to perform in the live market. Now you take it and put real money on it. Sometimes what you need to do is start with a smaller account than what you anticipated and let it work. And as it's working, see how it's filling its orders, monitor its performance. And if you need to optimize, that'll be the time to do it. But, it's go sim, then go live with real money, smaller account if you can, and see how it performs. And that's it. That's 8 steps to go through. So now that you've made it to step 8, what happens from here? Well, from here, it's continue to evolve over the 8 steps as you build more strategies and have more strategies available to you. You don't want to have all your eggs in one basket with one strategy. You want to be able to keep evolving. The market keeps evolving. So you want to develop a system to go through those 8 steps so that you have good, healthy strategies constantly in the market, taking risk and making money for you. And if all that sounded very intriguing and you want to learn more, we do offer a mini course as well as for those of you that are ready to do the deep dive and get an algorithmic strategy off the ground in the next 30 days. We have a course on that as well. Just head over to the Independent Quant, sign up for our newsletter, and I look forward to seeing you at our next episode.